Yo, what's good? This is the results of trend following. It's starting in 1990. This is tracking Chesapeake Capital by Jerry Parker. He's the manager. It's a total trend following system. Jerry Parker is one of the turtle traders. Chesapeake Capital. On Autumn Gold that tracks CTAs. And the yellow is your money at $1,000, called VAMI. I don't exactly know what that stands for, but it starts with your $1,000 at the start. That's your value of your $1,000. Okay. The blue line is the assets under management. Okay. He clearly had a shit ton of assets under management at one point. Oh my gosh. Assets in millions. That's 1.7 thousand millions. I don't know what that number is, but it's huge, bro. It's huge. Anyways, let's see. 1990 it began. This is what trend following does. It goes up and to the right. Okay? It goes up and to the right. And it's not correlated with the stock market. That's the most important piece of this puzzle, bro. Everything's correlated with the stock market. This isn't. This does not have correlation with the stock market. Let's look at 2008. Where's 2008? We know that one went down, right? The stock market went down in 2008. So you can see that there is some chop, and it didn't really go down that much. Not the stock market. The stock market graph probably popped lower. This didn't. You can see the rate of return in the past 4 years is down 4%, up 5, up 12, up 20, down 10. Right now we're up 5. I mean, dude, it works. Look, there's drawdown. We believe it. We know it. We know there's drawdown. There's 10% in a year when the stock market was up freaking probably at least 10% last year. Well, why would I do that? You're down 10%. Why would I go to you? Why would I ever go to you? It's because this is not correlated with the stock market. And when you have a big market loss and the world is suffering, including yourself, you don't necessarily have to suffer with them, dude. You can have half your money in a trend following system for long term and deal with some drawdowns. But in general, it goes up, bro. Long term, it goes up. It does. And this is tested over time. This is tested in various market conditions, and it's diversified, my friend. The trick to trend following is diversification. So, meaning we don't bet on one thing. We bet on 70 at the same freaking time. Might be 30. I don't exactly know what they do, but they've talked about in numerous podcasts that I track is when the market's going up, they get in. And there's different ways to know how a market's going up. They don't speculate if the market will go up. The market has to go up, and then they get in. They will never catch the bottom, and they will never catch the top too. When it starts topping and going down, oh, it's going down now, I get out. They'll capture that in between spot. So that is trend following. Those are the results. This is just, I didn't look. I know Chesapeake is from Jerry Parker. I know it's a trend following. I didn't look at this beforehand. Shit goes up and to the right, my friend. All right, peace. Good. This is my review of trend following. Trend following by Michael Covel. Learn to make millions in up and down markets. Up or down markets. Trend following, essentially, from what I got from this book, is that it's a systematic, proven way to make money, make some return, if the market's going up or down. And yeah, that's basically it. How they do so is they follow trend. If the market's going up, whether it's breaking 52-week highs or 14-week highs or whatever, and it's going up, it has to go up to break highs, right? It's starting to do that. they start buying. They buy, and it depends on the manager, but they have a trail stop methodology. I'm pretty sure all of them do. I mean, that's what they preached in this book. Because they only exit through a trail stop. They don't set targets. Okay? So, and this is a long term. Look, they hold trades for weeks, months, sometimes a year or more on large winning trades. Okay? And most of the time their trail stop methodology is, say you have 1R risk box, it goes up 1R, they won't trail it yet. It goes up 2R, now they trail it to break even. So now you actually have a 2R risk box because your risk is at break even, but you have 1 and 2R of worth of risk. So now you have a larger risk box. Okay, now you have you give it more time to breathe. It goes to 3R, you don't trail your stop. It goes to 4R, now you trail your stop once. Now your trail stop's at 1R, but the market's at 4R. Now you have a 3R trail stop. You see how it's widening up, and that's the nature of trend following. They don't want to get knocked out. They want to stay in with a decent limited risk, and that's what they do. So they want to stay in. They want the whole thing to run. They capture large moves. Okay, if the market's going up and Apple has to go from $300 to $400, it has to cross 325, bro. It's got to cross 325 to get to 400. So they buy at 325, and they have their stop at 300 or whatever it might be, and they don't get out at 400. If it tops at 400, it goes down to 375, then they get out. So they capture that middle chunk. That's how trend following actually operates, and they do it in a higher time frame. Okay, very big time. This is large movements. When you see, cocoa up 1,000% last year, I think it was. You see it like, I got a ticker up here. It's not on right now. It's a stock ticker, and it goes from left to right, and no one looks at, in this half an hour it went down this much. Like, I'm on the smaller time frames. People look at the month. People look at the year to date. They look at these larger things. The cocoa's up 1,000% this year. Yada yada. I mean, and we're in November, 11 months in. Those are the stats that trend followers are on. They are riding cocoa. They're still up, and they still not selling. And they won't sell until it tops in what they think is a top. There's tons of false flags. Happens all the time. It destroys trend followers too. Because a choppy environment falls, so it goes up. Oh no, comes down. That destroys trend followers. It does go down. Okay, I'm not saying they always win, but that's what it is. They're into the big trends. All right, they're into the big deals. They're into the weekly, monthly trends, bro. Huge, powerful moves they're into because they have a shit ton of money. And they don't do high frequency at all. In fact, they say they're against day trading. In this book multiple times, because I'm a day trader, I'm trying to be a day trader. I've looked, I pay close attention to what they say about day trading in small time frames. They're so against it. They're always against it. There's so many spots where they're just where they hate it. And I can talk all day on that one. There's one that's here it is. Limitations in day trading. And it says, when you trade more or with higher frequency, the profit you can earn per trade decreases, whereas your transaction costs stay the same. That is not a winning strategy. Then it goes, professional short-term traders such as Jim Simons have hundreds of staffers working as a team 24/7. They are playing for keeps, looking to eat your lunch in the zero-sum world. You don't stand a chance. Yada yada. And they just yeah. I just don't like what they say about day trading, but they could be right. Who am I supposed to know, just because there's other people in the world doing it, I don't stand a chance. I mean, Jim Simons, he's not an alien, bro. He's not some OP character. He's a human being just like me, bro. Yeah, he's wicked smart. Yeah, he's gone to all these schools. Yeah, he's focused. He's still a human being at the end of the day. And what's separating me from him, all these people from him, anybody from him, is practice and freaking discipline and learning. Some people are more naturally gifted, yeah. Doesn't mean you can't freaking do something. There's always going to be someone better than you. Why give up? You know? Oh, there's someone better at me than that. There should be. I mean, you're never going to accomplish anything doing that. That's the worst attitude in the world, bro. I don't like that at all. So, that's what I disagree about this book. But anyways, this is not a book about day trading. This is a book about long-term trends and how it wins. I'm going to put a video at the end of this video about looking at the results of trend following, and it is interesting to see. Now, here's the deal. Trend following, what's the worst thing that can happen? Chop. Goes up, breaks the 52-week high or whatever signal they have to go in long. And it breaks, and that comes down. You get stopped out. And they get stopped out constantly, and that breaks things. The reason there's this, they researched trend followers, and one thing that I find interesting is that they basketed all these different trend followers. They don't talk together. They're not mingled. They're all separate companies, and they are all qualified as trend followers. They call themselves trend followers. Now, this composite, they're all correlated. In 2008, they were all up. All of them. To varying degrees because they have different risk preferences. But for the most part, they're correlated. Everybody's correlated, even though they're not talking to each other and they're not saying, hey, yeah, I'm going long cocoa. You want to go long? Okay, let's go. No, they don't do that. Their system does that, and all the systems are somewhat different, but most of them are pretty much the same. How else do they get the same results? They get pretty much the same results across the board. You get a trend follower A, it's pretty close to trend follower B. Pretty close. I mean, you're going to get the same correlation, okay, with the results year to year. The difference is the risk. The difference is how much pedal do they put on the car? How much freaking do they want to risk to get more? Because they can always up risk or down risk. It's a dial, and it's purely systematic. Okay. So I find it interesting that they're correlated. That's one thing that is good in my opinion, because it's not just one thing doing this, one company, one everything. It's a industry is trend following, and they dominate the CTA space, the commodity trading advisory space. Okay, so there was this statistics on that composite, and it shows percentage of time that trend followers make money in a day, in any day. 54% of the time. Okay. Percentage of the time they make money in every month. 56% of the time. That's not that good. Percentage of the time they make money in any 3 months. 64% of the time. Okay, it's going up. Percentage of the time they make money in any 6 months. 77% of the time. Okay. Percentage of the time they make money in any 12 months, in any year. Any given year, 92% of the time. Wow. Percentage of the time they make money in any 2-year period, 100% of the time. Okay. I think that they nitpicked the best results and then did it. Yeah, they they used Salem Abraham's stats, and he had really good stats over this period of time, but still what it illustrates is that the smaller days, they might not be profitable in the day, the week, or the month, but they should be profitable over the 12 months because trends happen. You trap a market in a box. that shit's going to break out of the box. It's just going to. You just try to condense a market. Try to say, market, don't go this way, don't go that way. No, you stay here, you stay here, you stay here. It doesn't, bro. The market just fucking moves, and the market goes down, and if it's going down, they're on it. They don't miss a trade. Trend followers religiously do not miss trades because they never know which trade's going to be the winner, which trade's going to be a big, big win. So they take every single trade. It's systematic. It's purely algorithmic. But it's not high frequency algorithmic. It's long-term algorithmic. Algo. That's what trend following is. It's really interesting, actually. I think it's decent. The drawbacks. What's the drawbacks? The drawdowns. The drawdowns are the drawbacks. Okay? There's years that there's periods of time in the months, 6 months at a time, you are going to lose 15% of your money, bro. In 6 months, you're like, what? You know, the market's not down that much. The market's up 7% this year. What are you doing? Like, why would I be here when I'm losing this much? Because they were just waiting around for the market to move, okay? They don't know when the market will move. And they trade all these different symbols, okay? All these different symbols. So yeah, all these different symbols at the same time. If the market's moving, they're in it. If the market's trying to move, they're in it. And then if it decides to go back to normal mean reversion and the market doesn't want to move anywhere, they get ripped apart, man. They lose their stop order. And guess what? It's only 1 hour. They have risk management in place. It's all systematic, purely systematic. It's managed. That's why they all get similar results, because no one person is just deciding things. The system is set, and they just have it. They just run it. It's an interesting book. I didn't agree with everything in this, but I think I'm actually happy I read it. And I only read it because I had an interview with this hedge fund manager, smaller hedge fund. Hey, Nathan boy. And he told me I should read it. All right, I gotta go.